Hey everyone, welcome back to another dividend investing video. Let's say you're a complete beginner to dividend investing and you want to get started by building your own dividend snowball, but you're confused on how to get started. What stocks should you buy? How much do you need to invest and where do you invest? How would I invest $1,000 today in a new dividend portfolio here in the year 2024? That is a question I'm aiming to answer, and I'm even going to build a sample portfolio with $1,000 the way I would if I was starting over today brand new with just $1,000. Really, you can use any amount of money to get started. You could even do it with $100. The important thing is truly that you get your money working for you. The sooner you do that, the sooner you could be on a path to financial independence. Building a dividend portfolio can put you in a fantastic financial position, and sooner than you think, but only if you get started. I'm Nick, and this is the Dividend Growth Income Channel. Thank you for joining me today. I'm not a financial advisor or guru. I'm just a regular guy who wants to share my love of dividend growth investing and building financial independence with passive income. If you could, please do me a favor, smash the like button and subscribe to keep up with future videos. This helps us out more than you can imagine with the algorithm, so we can bring you more quality dividend investing content. Also, guys, down in the comments, feel free to leave me any question you want for my upcoming Q&A video that I'm going to be putting out in a few days. Now, starting out, I'd recommend you sign up with a brokerage account that allows you to purchase fractional shares. That is, you purchase in dollar amounts rather than specifying an amount of shares. This way, you aren't going to be focused on the price of the stock itself. This is really not something that we should be caring about. We want to invest in the highest quality companies possible. So if you're not using fractional shares and your funds are limited, you might be doing yourself a disservice because you're looking for stock that fit a certain price. Now, brokerages you can use as of January 2024 that fit this bill are Fidelity, Robinhood, and M1 Finance. All of them offer both taxable and retirement accounts. I have accounts with the first two, no complaints whatsoever. Many are also happy with M1. That's a very automated platform, I believe. I personally like a little more control. So Fidelity is my preference. It's the app I use for my public portfolio here on YouTube, and I'm very satisfied with my experience thus far. I'm going to briefly talk about the difference between lump sum investing and dollar cost average investing. So lump sum simply means you're taking a large chunk of money and investing it all at once. This could be preferable because time in the market is usually better than timing the market. So let's say you fund your Roth IRA fully on January 1st. Those funds are going to be working for you throughout the entire year. Now, while dollar cost averaging is the act of investing smaller amounts of money over a consistent basis or schedule, and the idea is that you're buying, say, every week, every month, over the course of the year, so your average cost will be the average price of your investment over the course of that year. Now, for 95% of us, we will be dollar cost averaging just because of logistical reasons and because funds are limited. Now, if you're just starting out, make a point to set aside a certain percentage of your income for investing for your future, but maybe you have a nice chunk of cash to start your portfolio. Regardless of the size of your initial investment, I have a plan here that can be executed upon. You do this enough, I believe you'll find yourself looking for ways to push yourself a little harder as you start to build your portfolio. When thinking about the dividend stocks you're going to select in your own portfolio, in my view, there are three types of dividend stocks you're going to be focused on. And the portfolio I'm building today is going to use a mixture of all three of these. The first group I consider high dividend growth. These are usually companies that are consistently pushing out double-digit raises year over year, but they will usually pay a lower dividend at the time being, sometimes as low as like 0.5%, but they can pay as high as 2 to 2.5% usually. They feature low payout ratios because they're reinvesting in their business heavily. The group will typically outperform and are there for the total growth picture, growing your investment and your dividend income. You're going to sacrifice current yield today for total growth, both on your investment and your dividend income. So if you have a lot of time on your side, these are a wonderful place to focus. Think Microsoft, Costco, Visa. The second group I call your core dividend stocks or classic dividend stocks. These are usually going to fall between the 2 to 3.5% yield range. These companies are going to be reliable histories of growing their dividend, probably in the mid to high single-digit rates, reasonable payout ratios. These are usually blue chip companies with lower beta, lower volatility. They typically perform in line with the market. Think Johnson & Johnson or PepsiCo. Great examples. Then finally, you have what I call your high income stocks. These are straight up for dividend income today. These are going to yield 4, 5% and beyond. Payout ratios are going to be high. Dividend growth will be slow to non-existent in some cases. The dividend's going to be a little riskier. They'll typically underperform the market. They are best for investors who need dividend income today, such as retirees. And I believe they have a role in providing cash flow into your portfolio as well. But remember, these are going to underperform. And if you have 10, 20, 30 years until you plan to retire and use your dividend income, then you might prefer to focus on this group the least, or maybe even avoid it altogether. So you think Realty Income, Main Street Capital, Altria Group. Okay, so pretty much every dividend stock I sort into one of those three buckets. In the same portfolio I build today, I'll use stocks from all three, but in this cases there's overlap as well. You can decide what group suits you best. I think for most of us that's going to be from the high dividend growth and from the classic dividend stocks with a less focus on the high income. Now I'll show you how I would build this portfolio if I truly had no money invested. I would likely get my first 10K into an S&P 500 index or a total market index. Think SPY, VOO, VTI, something like that. If you have a 401k at your employer, it's also an excellent way to hit this goal, and you can use that employer match to help get you there quicker. But for the purpose of this video, I'm just not using ETFs. We're going to stick with high quality companies. And to get started, I always suggest investors stick with companies they know, they're familiar with, and they understand. Even better if they use them in their day-to-day life. Now, as I build this, I'm picking stocks from various sectors of the market. I want to be diversified. Say financials are down in 2024. That might make it a good time to buy into that sector. So if you have a company or two in that sector, it gives you a place you can maybe focus a little more energy. So I'm going to build this if I'm starting out and I have $1,000. I'm committed to building up these positions by dollar cost averaging every time I get paid. So we're going to go with 10 stocks. So if you have $1,000, you're going to start by buying $100 worth of each. If you have $500, you'd buy $50 worth of each. If you have $100, you'd buy $10 worth of each. This scales in either direction. And disclaimer, I'm not actually telling you to buy this portfolio. It's just an example, okay? And then I'd like to see, weekly, monthly, whatever you could do contributions throughout the year to continue building these positions. So the first stock I'm going to pick is one of the mega cap tech stocks, either Microsoft, ticker MSFT, or Apple, ticker AAPL. I really can't imagine investing and not owning one of these two stocks. I don't need to say much more than that. For my second stock, I'm going to stay in the tech sector, but go with a semiconductor stock. My favorite is Broadcom, ticker AVGO, and another very awesome stock in that sector is Texas Instruments, ticker TXN. So pick one of those two. Both are high dividend growth stocks, and they have decent yields as well. Broadcom has 13 years of dividend growth with a 5-year average annual dividend growth rate of 19.25%, while Texas Instruments has an 18-year track record of paying a growing dividend, and its 5-year CAGR is nearly 14%. Now, the third stock I'm going to look at is in the financial sector. I'm going to pick one of the major payment processors. That's either Visa or MasterCard. They're high dividend growth stocks that offer very little yield, but both of these stocks have been compounders with high dividend growth and total returns that more than double the broader market. Visa has a 10-year total return of about 387%, while MasterCard has a 10-year total return of 449%, while the S&P has a total return of about 212% over the last 10 years. So if you're looking for some more income in that sector, you could also go with one of the Canadian banks. They pay reliable dividend income such as TD Bank or Bank of Nova Scotia, ticker BNS. So do what works for you there in the financial sector. But having a good stock in the financial sector makes a lot of sense. All right, the fourth stock I would add, I'm going to go to the consumer staples. I'm going to pick a dividend growth stock, classic dividend king, PepsiCo, ticker PEP. You can also go with Coca-Cola, Hershey's, or even Procter & Gamble. Consumer staples, most of these fall into that classic dividend stock bucket. Pepsi and Hershey's have superior dividend growth out of this group, I think. And I always prefer dividend growth to dividend yield, especially if you mean to beat inflation. For the fifth stock, I'm going to go into the consumer discretionary sector. I would pick one of either McDonald's, ticker MCD, or Starbucks, ticker SBUX. Both are classic dividend stocks with a solid dividend growth track record. McDonald's has a better total return, but I wonder if over the next 10 years, Starbucks sees more growth. I think you do great with either one, though, from both an income and growth perspective. For the sixth stock, I'd like to add a retailer into this mix. Most of these are consumer discretionary as well. I would pick one of either Home Depot, ticker HD, or Lowe's, ticker LOW. Both are home improvement retailers. These are fantastic long-term dividend growth investments as they hit on both dividend growth and they pay decent income as a bonus. Home Depot has been growing its dividend for 14 years. Over the last 5 years, has an average annual growth rate of 15%. Meanwhile, Lowe's has been at this dividend growth thing for 60 years with a 5-year CAGR just shy of 20% annually. Granted, its latest raise was on the underwhelming side, but that 60-year track record puts Lowe's in the elite club of dividend kings. Other options here for retail could be high dividend growth stocks like Costco, ticker COST, or Kroger, ticker KR. Lots of retail has high dividend growth. For the seventh stock, we need to add some healthcare exposure to this portfolio. If I want a high dividend growth stock in the mix, I would go with United Health Group, ticker UNH. And if I wanted a classic dividend growth stock, I would go with Johnson & Johnson. It has a little more yield. Or you could even go with a high income stock like Pfizer, which is currently yielding 6%. That's ticker PFE. UNH has a super impressive dividend growth metrics. Its last 30 years of uninterrupted dividend payments and 13 years of dividend growth, growing at a rate of 17% on average annually over the last 5 years. And J&J is about as consistent as it gets, right? A dividend king with 60 years of dividend growth and over 100 years without a reduction. Extremely consistent, 5 to 6% raises every year. For the eighth position in the portfolio, let's look to the industrial sector, which has a whole bunch of great dividend stocks. I really like what Snap-on, ticker SNA, is offering right now. 15% dividend growth, rock solid dividend coverage, with shares yielding 2.65%. That's above average for this kind of stock, for sure. Other fine options in industrials include Waste Management, ticker WM, Automatic Data Processing, ticker ADP, John Deere, ticker DE. You can go with a defense contractor like Lockheed Martin, ticker LMT. Lots of great stocks in industrials. 2 more to go. These stocks are going to be mostly high income stocks for these last 2. For stock number 9, let's go into the energy sector. I like either Chevron, ticker CVX, or ExxonMobil, ticker XOM. Just pick your favorite of those 2. Chevron is a bit stronger in the dividend growth department with a 5-year average CAGR of 6%, and that's with a 4.15% yield. Pretty solid. I own it myself. For the last stock, I'm going to go into the real estate sector. Why not collect monthly dividends with Realty Income, ticker O? These guys are the landlord to retailer. These guys are landlord to retailers such as dollar stores, grocery stores, drug stores, and more. And it's definitely an income play, but they're growing their dividend by a couple percentage points every year, and they are a dividend aristocrat. If you want more dividend growth in that sector, you could also look at American Tower, ticker AMT, which has been growing its dividend on a near quarterly basis. But yes, real estate in that last spot. So that gives us 10 options. So let's go ahead and bring up a spreadsheet with a portfolio like this, and let's examine how that would look. All right, this is probably the way I would do this right here. You got Microsoft, Broadcom, Visa, Pepsi, McDonald's, Home Depot, UNH, Snap-on, Chevron, and Realty Income. And I actually have ownership in all 10 of these stocks in at least one portfolio today, but wow, this portfolio to me looks about perfect. It doesn't spit out huge dividend income at a 2.43% yield, but this is more than 1 percentage point higher than what the S&P 500 pays. And look at the metrics here, which I would argue are far more meaningful than yield for a long-term investor. Like out of these 10 stocks, 2023 dividend raise averages out to 11.3%. And the 5-year average dividend growth rate came out very similar at 11.32%. And the average 5-year total return out of these is nearly 140%, while the S&P 500 returned about 100% in that time frame. And the average 10-year total return out of these was 618%, while the S&P 500 returned about 212% in that same time frame. So this portfolio beats the market over the last 10 years, features double-digit dividend growth, a yield that pays 1% higher than the S&P 500, and you're nicely diversified with 10 stocks. And thanks to fractional shares, you can contribute to these and build them up in small amounts at a time. Just keep at it. You invested $1,000 here, and that's going to get you about $24 over the next year in dividend income. Every portfolio starts somewhere, so if you kept at this consistently for the next several years, you would find yourself in a fantastic position. Think of this as a $1 million portfolio, and I can show you what that looks like here. Getting a 10% raise on $24,000 of annual income, just think about letting that compound for the next several years would do. And here is an alternate portfolio, the same kind of format, just different, selecting different stocks. And see, it came out pretty similar. Now, I want to know down in the comments, what stocks would you have your eye on here in 2024? I have some good ones in mind. I'm going to be putting out more videos to share those with you. I just put out a video recently about my 3 favorite REITs for the year, real estate investment trust for 2024. And to find out those, just go ahead and click into this next video. Thank you for sticking around. And until next time, keep investing.